Hey, it's Lon Welsh at Your Castle Real Estate, and I've got my guest star, Joe Massey, who's our in-house mortgage lender here, to talk a little bit about what's going on in the mortgage market. So we're going to show you a chart here that shows the average mortgage rate for a 30-year fixed mortgage over about the last 40 or 45 years. And there's a little gray bar that indicates the 6 recessions that we've encountered over that time period. And what you can see is that the mortgage rates have fallen every single time there's been a recession. And there's kind of a lot of discussion in the economy that we're going to come up on a recession soon. Joe, what do you think is going to happen this time?
Yeah, so if you look at the chart on the far left-hand side, you'll see the various different recessions, and we took an average of how much do interest rates improve coming out of each recession. And you'll see 2.4% is the average improvement of interest rates as you come out of a recession. But look on the far left, and you'll notice that in the 80s, interest rates were really, really high.
In the teens.
Right? And so interest rates came down almost as much as 5% exiting those recessions. Looking over further to the right-hand side, you notice that interest rates still improve coming out of a recession, but it's not as much because interest rates were not as high.
Right. So that would be like the 2000s, 2010s.
That's right. So over recent history, coming out of recession, interest rates will improve by 0.9% if you average the last 4 recessions. So right now, interest rates fluctuate between 6.5% and 7.5%. We've touched on in other videos that I think that's going to kind of be the range that we're going to operate in for the next 90 days or more. Coming out of the recession, I don't think we're going to see interest rates improve by 2.4, 2.5% because interest rates aren't in the teens. No, right?
But 7.5 is not that high over a 50-year average.
That's right. So I think you might see interest rates improve at some point in the future by a point, 3/4 of a point, maybe 1.5 points as we exit the recession. But the important point for your buyers is share with them, it might still be a good time to buy now. And if rates improve in the future, you can certainly refinance. But if rates go up in the future, you look like a genius because you bought at the perfect time and were not subject to those increased interest rates that may be coming down the road.
So for reference for our viewers, if you are, let's say, at a 7% rate that you've got today, and if rates were to drop by a full point to 6%, is that usually enough to make sense? Or what's the threshold of a gap of the rate drop that
between 0.75% and 1% generally makes sense to look at a refinance.
Got it. And would you expect, like, if someone bought now and maybe they're doing this refinance in 18 months, would there be like some market appreciation, or maybe they've paid down the balance on their loan a little bit?
Yeah, with the appreciation we've seen in the past 2 years, you would expect 10 to 15% appreciation over that time frame. I think that might be a little optimistic for the coming years.
But even like 5 or 10% would probably help a lot.
Yeah, 5 or 10% appreciation. That's going to help you reduce your mortgage insurance, potentially eliminate it depending on how much money you put down, potentially qualify for a better interest rate. Also, potentially when you get a new mortgage, oftentimes your credit score improves after you have that loan. So 18 months from now, you might have a much better credit score and be able to factor that in to qualify for a better interest rate as well.
Okay.
So buying now and looking at this again in 12, 18, 24 months could be a really good opportunity.
And then one last question, there's a lot of closing costs for a buyer, loan origination and title fees and appraisals and all that. Would they have to pay for all that out of pocket when they do the refinance, or is there a way to push that into the loan?
It's all included in the loan. The only cost you have out of pocket is the appraisal if you have to have one.
Okay.
But sometimes you don't even have to have an appraisal. So generally, all of those costs are included in the loan, and it's 0 cost out of pocket for the buyer to do a refinance.
Excellent. Thank you so much.
Yeah. If y'all have questions, call, text, email. Would love to chat.